It's about 15 minutes at the top of the hour, and it's now time for our big story. This morning, we are helping you out. Times are hard, we all admit, even government does. But the interesting thing is we're told to brace ourselves for tougher times. And even the IMF is predicting that some countries in 2023 will be having conditions similar to a recession. So if you had 10,000 Ghana cedis today, what will you be doing with it? And what are the options for you in terms of investment? Thankfully, I have the best people to help you see the opportunities and take advantage of them. This morning, I'll be speaking to Dr. Theo Champong, a political risk analyst, and Joe Jackson, Director, Strategy and Business Operations at Dalex Finance. We'll also have Courage Kwesi-Boti, Research Lead, Economist, GCB Capital. Let me start with Mr. Joe Jackson, because he's with me in the studio. Let me start by saying happy holidays to you.
Happy holidays.
How has it been? The Christmas season is just over. We are entering the new year.
For me, it was good. It was a time of rest, so it was good. It was a quite quiet Christmas for me. Had a lot of rest. So I'm approaching the new year with renewed energy, which all of us should try to do.
Right. Quiet by choice or necessity?
Oh, both.
Okay.
Both.
Right.
Definitely quiet by choice, but also this is not the time to do anything flamboyant. This is the time. These are difficult times. However you look at it, these are difficult times, and there are more difficult times ahead. So what you have, you hold. That's rule number one. What you have, you hold. This is not the time to go overboard and do anything crazy. It's difficult enough. So it should be quiet. For me, it was quiet by choice and by necessity.
Interesting. Let me come to you, Dr. Theo Champong. Good morning to you. Hope you had a good rest too over the Christmas holidays. What was it like for you?
Yeah, good morning. It was actually rather quiet here. Very much like Uncle Joe, I was also took the time off to get some well-deserved rest by choice.
I like that. But you are not here though, so you're not as badly hit as we are, right?
Not really, because you still get the request, right? We still have family back home, so there's people you've got to support. And then the occasional request that will come through for some sort of financial support or the other. So we're outside, but we still feel the pressure.
And one last thing before we get into the details of our conversation. I see that you are wearing clothes to keep warm. I understand it's extremely cold. Unfortunately, I saw in the news that some people lost their lives, some in their cars, and some, walking home got caught up in blizzards, and it's terrible. I hope you're keeping up, you and family and friends.
Yes, doing quite well, yeah. But yes, you're very right. It is quite cold. This morning was about -2 where I am, and it's been much colder the last couple of weeks.
Right. We thank God you're safe. That's the most important thing. So, Mr. Jackson, the big question, times are hard. For some people, it's extremely difficult. I know some people who've had to make very difficult decisions and adjustments, taking their kids out of certain schools because they can't keep up, with the payment of fees amidst handling other responsibilities. And is it possible? Is it possible at all to make anything good out of this situation by way of savings and investments?
It is. I'll urge a lot of caution, but there are definitely opportunities. The interesting thing is that in a time like this, there will be really good opportunities for you to make an investment that will yield well. You've got to be careful. You've got to make watch the markets carefully, but there will always be interesting investments to be made. There are obvious areas that we could talk about. At this moment, any investment in that agric food chain is, all things being equal, a good one.
Okay.
When I say the agri-food chain, I don't mean just taking a cutlass and a hoe and just going to weed. I'm talking about people who transport agri-produce. I'm talking about livestock. I'm talking about people who buy agri-produce at the harvest time and hold it till the, the lean times. And I'm talking about people who are investing in equipment and silos, that whole agri chain, obviously processing. So it's the most obvious investment. And if I had 10,000 cedis, my first thought would be, what can I do in that agri space? That would make sense, right? But that's not the only thing, because you got to remember that these are also very volatile times. Mm-hmm. This is also a time of very high inflation. So you got to think about two things. I want an investment that will keep my money, and I want an investment that, at worst, will minimize the effect of inflation on my money. And I'm not even necessarily talking about beating inflation, because at 50%,
that's hard.
It's hard to beat. I'm just saying I need to make sure that inflation doesn't eat away all my money. I want to make sure that in these volatile times, I'm taking the right decision. But the first and most obvious space is going to be the agri space. Mm. It's definitely going to be the agri space. If you had 10,000 cedis, first and foremost, look in the agri space. There are other spaces we can talk about, but the difficulty with the other spaces is that 10,000 cedis might not be enough to make much headway. Mm.
Interesting. What is it for you, like Dr. Theo Champong? If I came to you as a friend and I said, look, I'm struggling, I can't even save. Talk more of investing the money that I have. What are the ways in which you can prepare yourself for investment in a tough time like this?
Yeah, that's a good question. And of course, the first thing has always been, or we've always been taught to live within our means. And you need to be able to live and have some little extra for you to be able to use to invest. But like Joe was rightly saying, there are opportunities, and opportunities actually do exist. But of course, it's all subject to one's risk appetite in that sense, and also how long you're prepared to actually wait for to benefit from the upside of those opportunities. So within the agri space, yes, but I think even if you're fairly more risk averse and you're not necessarily inclined to take on some of the more risk bearing opportunities, then a good starting point actually is still going to be some of the government securities. So particularly, I'm talking here specifically about the Treasury bills. So within all the brouhaha about the government debt restructuring and the other exercise that they've taken place, individual holders or people who bought Treasury bills are not or have not been affected. And the government, even with the restructuring exercise, are still committed to honoring those obligations. So if you want a relatively pain-free investment, then in my point of view, the starting place really is the Treasury bills for that matter. But again, it's not really about making a return. Because where we are now, a lot of these investments are giving you negative returns. So at best, what you just want to do is just to keep the value or retain the value of those investments. And once inflation starts coming down, and if you look at some of the forecasts, that are available and some that I've also been privy to, inflation should start coming down or moderating from about the end of the first quarter of next year. Then from that point onwards, you're looking at potentially getting some sort of positive return. But for now, really, it's really about trying to keep as much value of those investments as possible. And I think that a starting point could still be the government treasury bills. Others too are thinking of, or I've got some of my friends who actually have bought other securities, so particularly like gold. Others have also got USD or dollar-based investments, all about trying to retain or to keep value, and not necessarily about making a significant return on it.
Yeah, you're talking about retaining value reminds me of the haircuts conversation. But you know, government has modified the debt restructuring, domestic debt restructuring program. Now it includes individual bondholders, and it's extended the deadline from the 30th to the 16th of January. But there are many options to consider, like you said. The other side of this is there may be businesses, organizations that may want to take advantage of people who are hungry for investment, even in these times. What are the things we should be looking out for in terms of genuine businesses or genuine places of investment?
Yeah, there would always be tempting offers, and people will come to you promising all sorts of returns. My rule of thumb normally with these things is anything that looks so fantastically not to be true, of course, ends up often not being true. So if someone comes to me and says that there is, for example, let's say a collective investment scheme that is offering returns in excess of like 100%, so almost doubling of your money in no time, I would be very, very worried, and I probably wouldn't put my money within that, because you see where we are, times are really hard, as we all agree to, and money is hard to come by. So, and it's very easy to use one's friends and people within their immediate circle to push through some of these very bad or even fake investment schemes. So we just have to be very careful. But anything that looks too good to be true, it probably is the case, and I'll be wary about that. I would rather put my money in the bank where we are now than to go and put my money in some of these, so-called high-yielding collective investment schemes for that. So we all have to be extremely cautious about how we go about making some of these investment decisions. And please make sure that you engage other investment professionals. Let even Google even be your good friend. So look out for information, fish out for information, dig around, and then try and consult more widely before you decide to part away with that really hard cash that you work for.
So you work within the space here in Ghana, and there are a number of stories that we can talk about when it comes to people taking advantage of persons who genuinely wanted to invest and get some good returns, as was advertised to them. Besides the offers that are too good to be true, what else practical steps we can take to ensure that our monies are in safe hands?
Well, first of all, first rule is stay clear of all these what I call fly-by-night pop-up investment schemes. They are invariably troublesome. This, as I said earlier, these are volatile times. So stay in a safe space. Stay with what you can understand clearly. You know exactly where the value is coming from. You can, I love what Dr. Theo Achampon said. He says, if it's too good to be true, it is too good to be true. But stay in the safe zone, right? And it's, again, we have to repeat, it's not about maximizing your return. It's about minimizing the effect of inflation. It's about holding the value of your investments and then waiting out this period. The worst thing you can do is to jump onto some fancy new scheme that has come up. And when I say a new fancy scheme, it could be anything from Bitcoin that somebody is touting to some scheme that is on Telegram or WhatsApp, to even others that your friends and will come and tell you about some fantastic new scheme that you are the only person that is best placed to contribute your funds. Stay in clear-cut, well-known areas. And I will even advise that don't rush to jump into any investment. Okay. Don't rush. These are very difficult times. And even with, we talked about T-bills, etc. The opportunity is there. But again, I would say, let's wait till after the 16th. Let's wait till the end of the month when we know exactly where this debt exchange scheme and the negotiations will end. Because unfortunately, if you read the small print in the government's, on the Bank of Ghana website for the domestic debt exchange program, it says clearly that the government reserves the right to extend it to other people and other categories. And you've already seen it extended to individual holders. So again, be cautious. Be very cautious. Don't rush into anything. If I were you, I would be looking at a simple investment. Walk to a bank, walk to a reputable financial institution, make a fixed deposit for a few months, 90 days, and then come back in 90 days and see where you stand and what is working for you. It's the main thing is caution. That's number one. Caution. You've got to be cautious. Number two, still safe. Whatever happens, I love the biblical verse. It says you must learn to abound and abase. Whatever happens, however difficult the situation is, even if it's just a CD you can put aside into a money box, do it. Do it. But above all, be careful.
But those who say, look, maybe the best time to save is when you have a lot, right?
No. The best time to save, you see, if you the issue with savings is this. We treat savings as if it's something we do when we have a surplus. No. Savings is something we do regardless of what we earn.
Okay.
That's why it's a percentage. So you earn 100 cedis, you save 5 cedis. You earn 10,000 cedis, you may save 500 cedis. But please make sure that you save something. Whatever it is, learn to live within your means. If Ghana had learned to live within our means, maybe we would not be in the situation we are now. So, even as a nation.
So is the effect of the top trickling down to the bottom, isn't it? There are many people, or probably is the case of people not having enough.
It is. It's possible not to have enough.
But you still must save.
Even if it's, I'm telling you, even if it's 50 pesos. It's a tough one, huh? I will be the first to lift up my hand and confess that saving. It's one case of do what I say and not what I do. But because I find it tough myself. I really find it tough. But I also know with certainty that whatever I have, I must save. That you shouldn't avoid. Whatever it is, if there's any investment tip really, is however difficult it is, save. And when from saving, then we can start talking about how to invest. And when you're ready to invest, be cautious.
Right. So for those of you who think that we shouldn't be having this conversation because times are hard, well, you just heard Joe Jackson there. He's Director of Strategy and Business Operations at Dalex Finance, and he's actually telling you the best time to save is now, not only when you have an abundance. Obviously, you should save in all situations, but it's always best when you save now. Dr. Theo Champo, when Mr. Jackson was speaking, I'm just asking myself, do we have that discipline as a people? Have we been taught how to save? And so he's talking about, even for him, as somebody who is in the sector, who's been doing this, it's quite a difficult thing for him to do. How do we begin to encourage and inculcate that discipline and that behavior of saving in the younger generation?
So you actually answered the question. You need to start from the very bottom up with our kids or with our children, and trying to encourage them not to always spend everything, but to keep something aside. But you know, it's a bigger problem, and this is why I do agree with the both of you that as a nation or as a people, often we have largely been living above our means. So our expenses tend to be more than what we get or collect in revenues, whether as a nation or whether as individuals. And what that then means is that often there's very little left. In street parlance, you may say we are just living hand to mouth. More. And that then becomes very difficult to save. But the thing I've also, learned over the years is that no matter what comes your way, if you're even earning 100 cedis a month, it is still possible to put aside 2 cedis or 1 cedi for the rainy day. And this is something that you see particularly work out with a lot of our women. If you observe, maybe growing up, our parents or our mothers always had some money somewhere, that they could use to be able to support us either in school or to do something. So normally, at the tip of their cloth, they had something tied to it, and they could always get that. Or there were even all these susu schemes around that allowed people within the informal economy or setup to be able to put something little aside. That used to be the case. These days, you don't see it as much as it used to. But the starting point really has to be with our education system and us being able to push or teach our children not to live above their means, that whatever comes their way, they need to be able to put something aside. After all, the good book, the Bible says that we should go to the ant and learn from his ways. That when times are plenty, you put something aside, and then because definitely there will be the tough times, there will be the lean season, and it is in those lean seasons that you need to be able to tap into the reserves that you have. And that principle applies whether it's a country or it is us as individuals.
But what are some of the practical ways? I mean, if I have a child, what is that? Obviously, my child doesn't earn. So how does a child even start to save? I just want really practical ways that we can get our children to start saving.
Let me give you what I've been doing with my child, right? We've got a little piggy bank, right?
Right.
And this Christmas or other times when they get something little, put some of that money aside into the piggy bank. when we go into like the supermarket or a shop, and you know how children are, I want this, I want this, I want that, you're able to actually enforce and say, no, you only have one particular thing and you stick to it. Even if they are crying and throwing tantrums, you're able to force or enforce that little thing because that's how they learn. And then they grow up, appreciating money and then subsequently being able to save, as well. So it starts really from the bottom up and from all those everyday interactions that we have with our kids, and that then ultimately ripples through the process of growing up as well. Again, if you recall, anytime an uncle visited any of us growing up, they might give us some little bit of money, right? So let's say 50 cedis or 100 cedis. And immediately your mom will take that money away from you. And you're going to put that aside. And that when it gets to Christmas or growing up, or let's say some sort of occasion, they will use that to buy that nice dress or something for you. So it's been there in some shape or form. It's just that sometimes it hasn't been institutionalized enough, either in our education system or in the way we go about it in the house. And that's why I think we need to push a lot more of us, into doing that. We need to live frugally, and we need to live in a way and manner that allows us to keep however little we can aside for those rainy days.
Let me come back to the studio, Mr. Jackson. There's a lot of mistrust in the system. We recently heard about some people who walk into the bank hoping to get at least the monies they invested, not any value added. Just give me what I invested, and they're told, well, we can't give you that. We need to give you a little below what you invested. We know with all the concerns about haircuts and all that. There are those who say, if I want to keep my money at least at its value, I can put it under my pillow. Or?
No. and it's also very important to maybe do a little bit of education as to the incidents of people not getting their money and the type of institutions that are unable to pay, and not to generalize it, because otherwise it just heightens the mistrust in the financial space. Now we have the institutions that are really manage your assets for you. They say, I'm smarter than you, I pool your resources and I invest it for you. When I invest it for you, if I make a loss, I pass it back to you. But hopefully, because I'm so much smarter than you and I understand the space, I will invest it wisely, make a return, and give it back to you. But I make no guarantees. And these are the institutions that are regulated by the Securities and Exchange Commission. And these are the institutions that in the last few days or weeks have had difficulty. First, they were told mark to market. So somebody gives them 10,000 cedis, they invest the money has lost value in the market, and they pass it back to the person, and the person says, I gave you 10,000. You didn't take it to a bank. And even if the institution sometimes may have a bank affiliated with its name, it's not a bank in quotes. It's not like you went to good old GCB or good old Echo Bank or Access or Zenith. Those are banks. There are also other financial institutions that are regulated by the Bank of Ghana, like the institution I work in, where we can guarantee a return for you, and you're doing like a fixed deposit. These are different, and it is those who are investing that have had challenges with giving, marking down their customers' investments because of the losses they have made on their behalf. It's not as if you took your money to an institution and it guaranteed you a return. Those institutions are not allowed to guarantee you a return. Very simply, if you're regulated by the Bank of Ghana, Bank of Ghana will take some money from you and say, that's why there's a capital requirement, and the banks had 400 million. Different categories of institutions have different categories and this is like a shock absorber for any losses made. It's different for the Securities and Exchange Commission. They are just people who are investing on your behalf. There's been a lot of blurring of the and I admit that some of these institutions have acted as if they were banks when they really were not. And all they were doing was investing your money on your behalf. If you make a loss, they pass it on to you. If you ask for your money, they have to go and liquidate their investments to come and pay you.
So it's not instantaneous.
No.
Like you go to the bank and say, I'm withdrawing this amount of money.
No, it's not a current account.
Yeah.
So it's you gave it to me to invest. If you want your money, normally I'll keep a certain amount of cash so that when somebody wants his money, I can give it to him without too much trouble. But if too many people ask for their money, then I have to go back, sell those investments. Now, unfortunately, in this environment, there are certain categories of investments that you are unable to sell. Today, if you invested in government bonds, you can't sell the bond. Nobody's prepared to buy until we know our fate with the exchange program. So they have made investments. They are unable to liquidate it. And they are now telling you that not only has your investment fallen in value, but they are unable to pay you. It is unfair in certain ways. It is sad in certain ways. But that's our reality today. And it's important that as we talk about investments, we separate those institutions from those regulated by the Bank of Ghana, who are allowed, if you walk into your average commercial bank today, they can give you a fixed deposit and they'll give you a good rate. It may not be a rate higher than, inflation, but at least it will minimize your losses. That's one other option available to you. Because we're talking about 10,000 cedis, so maybe buying gold is not a real option at that level of your income. But let's make sure we do understand that there are different categories of financial institutions. Those that are regulated by the Securities and Exchange Commission are in a different category. Their business is, I take your money and I invest it wisely, in quotes. And if I make a huge profit, of course you get it.
Roll it over to you.
If I make a loss too, I pass it on to you. And in the current climate, a huge loss is being made.
I'm happy you brought this clarity because it's important because most of the stories we've heard clearly indicate that people did not necessarily understand the kind of instruments or the kind of investments that they were making. Dr. Theo Champong, also on the bit of mistrust, while we're at it, how do we ensure that in getting ourselves out of this mess, we begin to get that confidence back where people can trust the system, trust institutions, and hand their monies over to them for safekeeping and investment?
Yeah, just to add a little to the last point that Uncle Joe made, that normally with any investment, within the fine print, there will be a statement that says that capital is always at risk, right? So it is possible to lose all of your money because people are just going to invest it, or your fund manager is going to put it on your behalf. Ideally, you want to make a return, but depending on the situation, depending even on the sectors that they invested in, you could always end up losing that money. And sometimes we don't read enough of the fine print. And also there is the issue of a lot of financial illiteracy within the system. You would be shocked. We did a study a couple of years ago where we asked a bunch of middle-class Ghanaians about 3 questions. One on their understanding of inflation, their understanding of risk, where you're asking two types of questions about compounding, and then there was another one that's just gone off the top of my head. And whereas many people understood kind of what inflation meant, the issue about the risk and the understanding of like compounding was very obvious that there is a major problem there that we address. So we weren't then sort of surprised when people started putting their monies into some of these, Ponzi schemes, as they later on turned out to be. I wouldn't want to mention any names, but we've seen a few of them in the system. So I think the issue of financial education is extremely important. Using all the channels that's available to us, mainstream radio, TV, like what we're doing now, and also within the education system itself, so that people can appreciate what it means to actually invest, what the risks and the consequences are, especially with the plethora of these so-called collective investment schemes that have come. Many of them whom are actually not even regulated by any of the two institutions. So you would have Bank of Ghana, or if it's in the classic investment sense, your Securities and Exchange Commission. And a lot of them, or a lot of these so-called collective schemes, are not regulated. And I wouldn't put my money in any scheme that does not have that sort of a regulatory assurance. So first thing, ask yourself the scheme that you're going to put your money in or join, is it regulated? Do you have recourse to being supported in the event of your money, or in the event of the investment not turning out to be the way they should? And then lastly, this is the point then to the regulatory institutions themselves. So here I'm talking about Bank of Ghana and then the Securities and Exchange Commission. I think they need to ramp up the public education campaigns as well. They've done their bit, and we saw them in the wake of the financial sector cleanup of crisis, deepen some of those engagements. But I think with a lot of the misinformation in the system about, like the debt restructuring exercise, and some of these very complicated or complex issues, there is actually an opportunity to further break down some of these technicalities and deepen the level of engagement that they have with ordinary citizens. And all of this collectively then would go a long way to ensure that we have trust in the financial system that we run in the country, because you don't want a run on the banks or a run on the institutions. That could actually really spell doom for all of us.
Right, we've just been joined by Mr. Courage Buti, who is with GCB. Thank you for joining the program. So my two other guests have been sharing with us what investment opportunities are available even in these harsh economic times. Mr. Joe Jackson just spoke to us about the differences in these financial institutions that exist and what you should expect based on what exactly that particular institution does. Let me find out from you, any ideas on how we can invest even in these times, and where we can put our monies?
Wow, good morning to Joe Jackson. Good morning to you, Dr. Theo Acheampong. And good morning to you, Madam Host, and of course your listeners. Merry Christmas, and we all look forward to a brilliant new year ahead. The challenges we envisage notwithstanding. So yes, it's a difficult time, we all know, especially in a country where it looks like all the investment laws seem to favor the sovereign. And in fact, if you look at the SEC directives or guidance, same as the NPRA and the many others, really, a chunk of our investments are supposed to be held with the government. And to the extent those rules or guiding principles do not even permit a lot of corporate and other asset classes, like in large quantities, really, it automatically puts a limitation on what you could do in this time where bonds or Ghana's debt stock is being restructured. There is a limit on, in fact, for 2023, I'm not expecting any issuances. In fact, even the budget says so on the local market. Maybe the issuances you would expect to be in T-bills and potentially rollover of some maturities. But even the acceptance for those is questionable because, yeah, if you are offering 15-year bonds, 10-year bonds, and stuff like that at 0% in 2023, 5% and 10% thereafter, really, it doesn't make any proposition for anyone to want to go into even buy any of the instrument you put on the market. And especially the question will be, what rate will even be rolling over those are that instrument, really? So they are rolling everything into a few bonds. And so we do not even expect some rollover transactions on the market. It makes the universe very limited for everyone. I mean, to try to, and especially for the fund managers who are looking for ways to diversify their portfolios and at least try to generate some good returns for their client. So I would say that in this time, the focus wouldn't be on returns because the returns are not available, at least within Ghana. The returns are not available. Maybe what we should be focused on was how to diversify our investment away from some of the risk associated with government. And so you want to look at some fixed deposits with some banks, and you also again want to look at the quality of these banks and then how they're able to withstand the shocks, their liquidity levels, their solvency levels. Because debt restructuring is happening, banks are about 33% exposed to, I mean, they hold about 33 or so percent of the total domestic debt stock, really. And so the non-payment of coupon and everything happening could affect some banks and potentially even affect their liquidity levels. So you want to do all of these analysis before you even go in there, not as a way of generating so much return, but as a way of diversifying. The stock market is a place a lot of people have shied away from, obviously because of the risk, the price volatility, and of course the economic cycle we have now where we are not churning our high growth and all of that. A lot of the sectors listed on the bears might not be on top, really, but nonetheless, there are opportunities in there. In fact, even in this year, where the market is returning some negatives, there are stocks on that bears that have generated so much return for investors, really. And so you want to look, and in these ones, you do not want to just use your own discretion, go to the market and purchase any stock. Talk to a broker, talk to an investment advisor, get inside, get the research reports, the fundamentals of those companies. And I believe when you do so, you might be able to find some good candidates for investment in these times, really, that you could expose yourself to. Maybe this is time to look outside the shores of Ghana. Have long wondered why, as a country and as an industry, we have over-focused on investment in the local market. But then there are opportunities out there. I mean, for the BlackRocks, for the City Group, and the many other fund managers, insurance fund managers that come to Ghana to invest, they are doing so because they want to diversify. They want to expand their portfolio, and they want to take advantage of other opportunities elsewhere. But it looks like we are over comfortable with local assets and all of that. I do not know of any rule in SEC directive or anything that bars us from investing in other security, so long as you can do the arrangement where there will be a custodian somewhere holding your security for you, and the transfer charges make sense, your FX exposure makes sense, and you can calculate your risk and then be on top of your game, really think those opportunities are in there. So what about some bond in Kenya? What about some T-bill somewhere? Of course, these markets do not generate the very high and absurd returns that you get on the Ghanaian market, but the game shouldn't be about returns at this point in time. It's about stable income, diversification, and protection of your principal. And so if we can find some quality sovereigns out there who are offering good deals and their fundamental sounds right, those are opportunities. And I think there are apps available now that can even allow you to trade in stock exchanges outside Ghana, really. And so we need to explore that. And again, do your best to talk to an investment advisor, get inside, get the proper advice before you go into some of these things. Again, I think in every storm, there is opportunity. We are talking about how difficult it is now for the sovereign and how they might not be able to raise money. But I believe for the many fund managers who still may be mobilizing, especially the pension funds, which is, I mean, mandatory and they still will be collecting flows really, they need opportunities to invest. And I think this is time for the local corporates, quality corporates to take advantage. If we have said that the sovereign has crowded that corporate and there are no opportunities for them to issue much, or even if they do, they are not getting so much demand for them. I think in the time that the sovereign will be absent from the market, maybe for a while, this is time for us as an industry and for corporate to open up so that we could partner and put out some of these institutions on the market. It will deepen our market, it will create new opportunities, and it will create new asset classes for investors to participate in. And you could do so even at much lower rates. Because if the sovereign is looking at 10 years and 10% over the long haul, and then a corporate, I want to think, comes to market maybe with a 2-3 year paper, I want to do 15%. I'm sure that is more than attractive, and fund managers will look at it favorably. So long as that corporate is quality and you prove that your flows or your cash flow support such a structure, I'm sure the market will be open to it. So I believe there are still opportunities in there for us to explore as a collective so that we can make the most out of the challenges we have presently.
It's interesting you spoke about international opportunities, because I was going to go there, but we've all agreed, when I say we, guest inclusive, that the times are tricky, okay? We are not too sure what we are going into, considering that our debt restructuring program is still kind of hanging in the balance. We are not sure if we will get our board level agreement with the IMF by first quarter of 2023. Would you advise that people hold on their investments now until all these are settled before we make that move?
Well, it pays to be cautious, right? Especially in times of uncertainty. You don't want to make any rash decisions. I do not think withdrawing your investments now is the best solution for anyone. I think it further unsettles the market. Jobs are at stake, and an industry is at stake, really. I mean, think of it. For those whose business is to manage funds, if everybody takes away their monies from your collective investment schemes and other investment vehicles you have, what would they be doing when they go to the office? And so naturally, people are losing jobs and all of that. And of course, you shouldn't make your financial decision based on someone keeping or losing his job. But I'm trying to say that if you took out that money today, you put it out there for a reason, for accumulating capital for some project or some future cash security, and the constants of life remain the same. You are investing for some project, you are investing for some health issues, you are investing for some retirement benefits and all of that. If you decide you won't go on with that, retirement will still come anyway. You will still have to build that house anyway. You still have to get those other stuff that you have been saving all this while for. So the solution might not be de-invest or take your money out, but the solution might be that any new money that comes to your hands, you are very careful and analytical where you put it. Because if you keep it at home, the risk is either your house catches fire, it gets burned, someone comes in to steal, or you spend it on things you never really needed. And then in the end, your financial security, which is what you are trying to protect, or financial independence, which is what you are trying to build for yourself, might just go down the drain. So whenever new money comes, if you earn your salary now, and maybe your habit has been save 30% of your salary, save 40% of your salary, if you earn it now, maybe, and I say this cautiously because I'm in this industry and my salary depends on how much inflows that come. Maybe instead of going into something that might increase your risk, you want to play it safe, go cautious. In fact, it's actually now quite difficult because even for individuals who are excused from the debt restructuring, you are affected. But can I suggest that if you are very comfortable with GOG at this point in time, and bonds are valued 40% their face value, 50% their face value, and all of that. And I hear now we've increased the number of tenors for the debt restructuring from the initial 4 to now, I think, 12, which means that there could be short-term maturities.
Yeah.
And so let me just do this simple analogy. Assuming I have 100,000, I want to invest in some government or Ghana bonds. It is not attractive at this point in time, no doubt. But then those bonds, 100,000 worth of bond may be selling maybe at 30,000, 40,000 now, at most 50,000 based on the market prices of those bonds. And so if you bought at 40,000, you are holding out for something maybe 100,000 in maybe 3-4 years time, and you are purchasing that at 40,000 now. So 60,000 becomes your return, not interest. I mean, your capital gain over the period of holding that bond. And so even if interest is 5%, 10%, by the time maybe that 5-year time comes, you'll be receiving your principal, maybe you are better off. Those could be very smart ways to play, but by all means, seek advice. Do not do some of these back of the envelope calculation in your living room and or your armchair and then spend your money. Please
Right.
seek the proper advice and get full insight. But I feel that even in the midst of the storm, there are still a lot of things to do, except that we just have to be very calculative about it and then be setting what we are going. Of course, you cannot be very certain with investment, but at least get the needed information that you convince yourself with that you've done due diligence before you go in there.
All right, gentlemen, we'll be wrapping up the conversation shortly. So let me start my wrap up with you, Mr. Jackson. Clearly, we know the banking crisis deepened the mistrust of the financial sector. Now, with what's happening with our debt restructuring, clearly, on government side, a lot of people will hold back and be hesitant to invest in government bonds. How long do you think it will take us to recover from this? Because I clearly see, even though we are trying by giving education, explaining to people the different financial instruments that exist, the type of institutions, what they are meant for, there will still be a bit of hesitance in the system. How long do you think it will take us to recover?
It will take us quite some time, frankly. The damage done to especially the asset management and the fund management investment sectors are going to, I estimate, anything between up to 5 years to recover. It's a lot of damage. It's a lot of extremely bad press. It's another blow to our financial sector when we're just coming out of the financial sector restructuring. This domestic debt, the domestic debt restructuring, the inability to pay that the fund managers are going through, the asset managers are going through, it's a tough one. It's a really tough one. And remember that even when the president spoke, he said it could take us up to 7-10 years to fully recover. I will tell you that I can't see any significant recovery for the next few years. If you are in the asset management, fund management space, you are in you're in a tight corner. And unfortunately, the illiteracy means that it's going to hit you hard. It's harder to explain. But these are tough blows that the financial sector is taking.
Talking about illiteracy, Dr. Theo Champong was the one who shared with us about that research they did for middle-income earners who you expect will understand some of these things to a large extent, but it appears that people don't really get a grasp of some of these issues. And I'm glad that Mr. Jackson has taken us to, if you just joined the program, he basically explained what it means if you invest or put your money in an institution that is supervised by the Bank of Ghana as against the Securities and Exchange Commission, and what the guarantees are for the two. If you missed it, you can catch up later on Facebook or on YouTube. It's very important information you need if you want to be an investor. So for you, Dr. Theo Champong, what about lands? What about starting a business? I mean, I know we've spoken about investment in the Greek sector and investment in bonds and treasury bills. But what about starting a business? Does it make sense to start a business now, to say, I want to invest my money by having a startup which will yield me results, or even buy land?
I started off by saying it's all based on the risk appetite, right? And the data also shows that, in fact, most companies are actually created in the midst of a crisis. If you look at during the last recession globally, the companies that were created, because people are idle, and if you're idle, that's sometimes where your creative juices start, working. But then there are those that also just want to work and earn a paycheck and be able to put a little aside. So there are different categories of people here in that respect. Even with land, there's all the other complications with, ownership and how do you ensure that actually the land that you're buying is already not being sold to 5 or 6 other people in the process. So for me, I think in these times, we've got to be very careful. And I would rather, if I had that 10,000, probably put it in a financial institution. But the point also is that it's going to take a very long time. I think at the minimum 5 years, but definitely about 10 years to really recover the from this crisis. And again, let us be very clear that this particular crisis represents one of the biggest net transfers of wealth from the private sector to the government. In other words, we are pretty much subsidizing government consumption rather than what should have been the other way around. So, we are all collectively paying for the inefficiencies and some of the policy mistakes that have been made by the government in this respect. And that is something that I think is very important to stress on here, that for many of us who are caught up in this challenge, and those fund managers and investors, etc., basically what is happening is you are using your money, those investments, to subsidize future government consumption.
Interesting. Courage Kwesi, you have the last word here. And what would you say to a young person about the discipline of saving and why it's important that we do so regardless the times we are in?
Yes, because you have your life ahead of you. You do not know what will happen the next minute. It could be sickness. It could be some loss of a relative. It could be anything at all. I mean, the reality is that you are not guaranteed you will get up tomorrow and go work to earn your salary. And so all you can do, and it's a biblical principle, that go to the ants, learn of their ways. And what do the ants do? In the season of plenty, they gather so much just so that in the dry season or when we are in the lean season, they can feed on that. And that is really the principle of investment, really. And there is a hypothesis in economics. I'm sure my co-panelists are aware of this, the life cycle hypothesis, where your earning years are actually your early years and middle age. That is where you earn more. But it's the savings in those times that you would have to de-invest in your retirement or in your old age to be able to live that normal life if you want to sustain a certain lifestyle, really. And that is why it's important, even at a young age, that we start saving. Yes, we do not have to wait till retirement is staring us in the face. You have about 5-6 years to retirement, then you are trying to. I mean, you could save even 60-70% of your salary at that time. But the question is, will the time be enough to build that? But in this time where you are 20, you are 25, and you are working, you started working, putting away that 100 cedis, 200 cedis regularly and religiously would not only yield you interest, but compound interest over time, which will make whatever your total savings or returns will be over time quite significant and could take care of you in the times of uncertainty. And there are a lot of shocks that do come along our way that we need to prepare for. And for those uncertain times, really, it's imperative that we save, whether the economy is melting or it's good time, really. And that is why I kept emphasizing that. Just explore the best options. If you are saving for the long haul, you are not thinking of maybe selling it off maybe in the next year or two to get the money. And so it pays that you weigh your risk to know where you are putting it and how safe it could be over that long haul. Dr. Theo talked about a number of things, including new ideas, and you even suggested purchasing of land. For those who are advanced in years and are trying to manage liquidity, you want to be careful what things you go into. Yes, creative ideas could come, but what if you invest all your retirement capital or some other capital? Maybe you are out of job or something, and whatever end of service you got, investing in some business that will not exactly be profitable immediately. And of course, when people talk of business in Ghana, it's buying and selling. But I believe what he was talking about is real productive sectors, who are into some meaningful business and creating some value addition and all of that. You do not want to go into stuff like that when maybe it will take you 4 or 5 years to start generating real profits, and then you need liquidity immediately. Lands are good investment. They generate a lot of return, but they are not liquid. I mean, you could be trying to sell a land for forever. And so you want to balance the risk so that you can have, and that is what fund managers do for you, really.
Right.
Some short-term assets that can give you liquidity and put some at the long term so they can guarantee returns, really. And so if you want to do that on your own at this time, just be cautious of the dynamic so that you do not find yourself wanting in an attempt to put your money away.
Thank you so much, gentlemen, for helping us do this morning. And it's important because as we look forward to the coming year, a lot of us will be making new decisions, certain targets for ourselves. And so this should be something that should interest you as we move into the next year, how you can save, how you can put some money away so that you do not struggle in times like we're in. Let me say thank you, Courage Kwesi Boti, research lead and economist at GCB Capital. You just heard him in the studio. I have Joe Jackson, who is with Dalex Finance, and also on Zoom, we had Dr. Theo Echampo, a political risk analyst. You're still watching the AM show. Up next is our interaction with MP for Tamale North, Al Hassan Suhini. Parliamentary correspondent Kweku Asante brings you that.